Picture this. You are driving down the highway at, 80 miles an hour. Everything feels totally smooth.
Right, cruising along.
Yeah, exactly. The engine is humming, the temperature gauge is dead center, the road is clear. And then, out of nowhere, the primary master warning light on your dashboard just flashes this bright, blinding red.
Oh, the worst feeling.
Right, and it's not a subtle amber check engine suggestion, but like the aggressive, pulsing red light that usually means catastrophic failure.
And that's when your stomach just completely drops.
Exactly. You pull over to the shoulder, you grip the steering wheel, and you're just bracing for the inevitable realization that, your engine block is cracked, your transmission is destroyed, and you are about to hemorrhage thousands of dollars.
Just to get the thing towed, let alone actually fixed.
Right. I mean, it is a visceral, immediate panic response because we're conditioned to read that specific signal in one very specific way. Red means structural failure. Red means you are losing money.
And that conditioning is so hardwired into us that it just completely overrides logic. I mean, we crave binary signals.
We really do.
The market is up or the market is down. A company is profitable or a company is bleeding cash. We want the dashboard to tell us a simple story.
Because the underlying mechanics are just too complex to parse in real time.
Exactly. We rely on the warning lights to synthesize all that complexity into a simple, broken or not broken dichotomy.
But imagine you are sitting on the shoulder of that highway, just sweating, waiting for the tow truck, and a master mechanic happens to pull up behind you.
Okay, lucky break.
Yeah, right. He gets out, walks over, plugs his diagnostic scanner into your dashboard, looks at the code, and just starts laughing.
Wait, laughing while you're hyperventilating about the bill.
Exactly. You are sitting there dreading a massive repair bill, and he tells you that the red flashing light isn't a failure at all. In fact, he tells you the engine is generating so much raw, unprecedented horsepower that the car's computer simply couldn't comprehend the output.
Oh, wow. So it just freaked out.
Yeah. The software got confused by the sheer volume of performance and threw an error code. You weren't breaking down. You were actually sitting on the most powerful engine on the road.
I mean, the cognitive dissonance in that moment would just be staggering.
Right.
You have a deeply ingrained heuristic like red light equals bad, and it's colliding with a totally counterintuitive reality. And that specific tension, that diagnostic illusion, is the perfect framework for what we are looking at today.
Absolutely.
Because when you look at the headline figures from Gladstone Investment's recent quarter, you get a massive, glaring red warning light.
And we are stepping right into that tension today. So welcome to this deep dive. If you are joining us, you are likely parsing through data for your own portfolio review, looking past the surface level noise and, trying to understand the actual mechanical reality of the assets you hold.
Which is exactly what we're here to do.
Our mission today is to take a scalpel to the Q3 2026 earnings call for Gladstone Investment, ticker symbol GAIN, for anyone checking their terminals covering their quarter that ended December 31st, 2025.
A very interesting quarter, too.
It really was. We are going to strip away the optical illusions, the Wall Street jargon, and honestly, the GAAP accounting distortions to see what is actually happening under the hood.
And Gladstone Investment definitely requires that scalpel. You really cannot run their income statement through a standard screener or apply a generic financial toolkit to their numbers.
It just won't work.
No, it won't. If you attempt to read their quarterly results the same way you would read the results of, say, a massive tech conglomerate or a standard blue chip manufacturer, you will draw completely backward conclusions.
Because the architecture of their business model just defies standard categorization. Right.
Exactly.
So let's establish that architecture before we even touch the numbers. For anyone who hasn't dug deep into this specific ticker, we need to clarify the premise here.
Yeah, that's crucial.
GAIN operates in a highly lucrative but structurally unusual middle ground. They are a business development company, right? A BDC. And we know that BDCs are generally mandated to provide capital to the middle market. Those private American businesses that are too small for massive syndicated Wall Street debt, but way too large or complex for just a standard regional bank loan.
Yeah, a classic middle market. But GAIN doesn't play the standard BDC game.
No, they don't. How do they differ?
Well, the standard BDC playbook is overwhelmingly debt-focused. They are the lender of last resort, or rather the lender of specialized structural capital.
Okay.
A typical BDC underwrites a loan, collects a spread over a base interest rate, and honestly, clipping that coupon is their entire business model. They are a yield engine.
Just collecting interest.
Exactly. Gladstone Investment, however, operates essentially as a private equity firm that has internalized its own bank.
And that is the crucial distinction right there. Because when a traditional private equity firm does a buyout, they bring a sliver of their own equity, and then they have to go out to the broader market, right?
Right. They go to outside banks or even to traditional BDCs to borrow the rest of the money.
Exactly. But Gain looks at a target company and says, look, we aren't going to syndicate this. We aren't going to rely on a third-party lender. We are going to write the check for the debt, and we are going to write the check for the equity.
They do it all.
Yeah. They take the majority ownership position, driving the strategic direction while simultaneously acting as the senior secured lender.
And the duality of that structure gives them immense operational control. I mean, they aren't negotiating with an aggressive subordinate lender.
Right.
They aren't fighting with an outside equity sponsor over dividend recapitalizations or, capital expenditures. They just control the entire capital stack.
It's all in-house.
Exactly. The debt side of the stack generates the recurring interest income necessary to fund their monthly distributions to shareholders.
Which is the yield part.
Right. And then the equity side of the stack acts as a coiled spring, capturing the enterprise value growth that eventually leads to these massive capital gains upon exit.
It is a phenomenal model when it works, but man, it creates a nightmare for the accounting department. Oh, an absolute nightmare.
Because when you have to merge the predictable amortizing math of a loan book with the volatile mark-to-market valuations of a private equity portfolio, the resulting financial statements can look incredibly distorted.
Yeah, they really do.
Which brings us to the headline data drop from this earnings call. David Dolam, the president, and Taylor Ritchie, the CFO, laid out the metrics, and I want to look at the top line numbers first.
Okay, let's look at the baseline. The foundational metric for any asset manager is, obviously, the size of the base they are managing.
Right.
Total assets grew by $92 million quarter over quarter. So they are now sitting at $1.2 billion in total assets.
Wow.
Yeah, that is a substantial capital base. And that $92 million sequential jump was driven by a combination of one new buyout investment and some really significant appreciation within their existing holdings. I mean, a $1.2 billion base is a very healthy operating scale. It provides enough mass to absorb a few hits without threatening the entire dividend structure, but it isn't so massive that a $20 million capital gain gets lost in the rounding errors.
Exactly. It's the sweet spot.
But assets are just the balance sheet. What about the income statement? What did they actually bring in?
Well, total investment income, the TII, saw a very minor contraction. It came in at $25.1 million, down just slightly from $25.3 million in the prior quarter.
Okay, so barely a dip.
Right. And Taylor Ritchie broke this down, noting that while they actually collected more interest income from their expanding debt portfolio, that growth was offset by a slight decrease in dividend and success fee income.
And honestly, that makes sense. Success fees are inherently lumpy, right? You collect them when specific milestones or exits are achieved. You don't underwrite your baseline yield, assuming a perfectly smooth, linear realization of success fees every single quarter.
No, you definitely can't model it that way.
Right. So then we look at the adjusted net investment income, the adjusted NII, which came in at 21 cents per share, or roughly $8.2 million in absolute terms.
Yeah, and adjusted NII is the metric management aggressively points toward. It is their attempt to strip out the non-cash noise and show the market the actual cash-generating power of the core operations during that 3-month window.
Which is what investors actually care about for the dividend.
Exactly. And at 21 cents per share, it paints a picture of a stable, functioning credit operation.
Okay, but let's unpack this, because here is the massive contradiction. Here is the blinding red warning light on the dashboard we talked about earlier.
Right, here's where it gets weird.
You look slightly further down the income statement, past the adjusted metrics, and you hit the GAAP net investment income. Under generally accepted accounting principles, Gain didn't make $8.2 million. They didn't even break even.
No, they didn't.
They reported a net investment loss of $6.5 million.
Yeah, a very stark number, especially when you consider that just 1 quarter prior, that same exact GAAP metric showed a $4.3 million profit.
So you are looking at a negative swing of over $10 million sequentially on the bottom line.
It looks terrible on paper.
If you stop reading the press release right there, You sell the stock. I mean, a multi-million-dollar GAAP loss for a dividend-paying entity is a terrifying signal.
Oh, for sure.
But then you look over at the balance sheet, and the net asset value, the actual foundational worth of a company's holdings, didn't drop. It didn't even stay flat. The NAV surged violently upward.
It really did.
It went from $13.53 per share to $14.95 per share.
That's $1.42 per share increase in NAV in a single quarter.
That's huge.
For a mature BDC, a sequential jump of over 10% in intrinsic value is an absolute anomaly. It is a massive expansion of shareholder wealth.
So I have to challenge the mechanics here. I mean, how can a company mathematically post a $6.5 million net investment loss, which implies that their expenses completely overwhelmed their income, while simultaneously seeing the underlying value of their shares explode by $1.42?
It sounds impossible.
Right. You cannot be bleeding cash and compounding wealth at the same time. The math doesn't reconcile unless the rules of the game are fundamentally warped.
Well, the rules of the game are exactly what is causing the distortion. The math actually reconciles perfectly once you understand the rigid and honestly often counterintuitive nature of GAAP accounting for investment companies.
Okay, so walk me through it. Where is the disconnect?
The entire discrepancy hinges on the expense side of the ledger. Total expenses for the quarter spiked from $21 million to $31.6 million.
Wait, a $10.6 million sequential increase in expenses. For a company managing $1.2 billion, a sudden $10 million burn rate increase in 3 months is alarming. What did they spend it on?
Well, that's the thing. They didn't actually spend it on anything.
What do you mean?
No cash left the building. That entire $10.6 million spike was driven almost exclusively by a single non-cash line item. It was a $9.9 million accrual for capital gains-based incentives.
Okay, I want to break down the anatomy of an incentive fee accrual, because this is where retail investors get shaken out of perfectly good positions by algorithms and headline screeners.
Oh, constantly. It's a huge trap.
How does this mechanism actually work in practice?
Okay, so you have to look at the alignment of interests. Gain is externally managed. The advisory team that sources these deals, negotiates the buyouts, and manages the portfolio companies expects to be compensated for exceptional performance.
Right, they aren't working for free.
Exactly. They have a hurdle rate they have to clear, but once they clear it, they take a percentage of the capital gains they generate. It is the classic private equity carry structure.
Okay, that makes sense.
If they buy a manufacturer for $50 million, improve the margins, and sell it 3 years later for $100 million, they generated $50 million in raw value. They are entitled to a contractual cut of that success.
And that is the engine of the alternative asset industry, really. You want your managers highly incentivized to drive massive exit multiples. You want them hungry for the win, not just collecting a management fee for sitting on assets.
Precisely. But here's the catch. GAAP does not allow a company to simply wait for the final sale to acknowledge that liability. GAAP demands strict mark-to-market accounting every single quarter. They force management to look at the portfolio and ask a hypothetical question. If we liquidated every single company we own today at the current fair market valuation, how much of a bonus would we legally owe the advisory team based on those theoretical gains?
Oh, wow. So because the portfolio companies performed so exceptionally well this quarter, the third-party valuation firms marked up the equity value of those holdings.
Right.
The pie got bigger. And because the pie got bigger, the theoretical slice that belongs to the management team also got proportionally bigger.
Exactly that. The theoretical bonus liability increased by $9.9 million.
That is wild.
And GAAP rules require that theoretical future liability to be recorded as a current expense on the income statement right now. It hits the books with the exact same weight as a cash interest payment or a legal bill, severely dragging down the net investment income.
It is the ultimate paradox of success. I mean, the only reason they suffered a $6.5 million GAAP net investment loss is because their underlying equity portfolio generated an overwhelming amount of value.
Yeah, that's it. Exactly.
Going back to our analogy, the engine generated so much horsepower that the accounting software threw a failure code.
The master warning light.
Yes. If their portfolio had performed terribly, if the companies were stagnating and valuations were flat, they wouldn't have accrued that $9.9 million expense, and they would have posted a GAAP profit.
Which perfectly highlights the danger of relying purely on GAAP net income to value an entity structured like gain. You have to isolate the cash operations from the mark-to-market volatility.
Right.
That is why Taylor Ritchie emphasizes the $8.2 million in adjusted NII. That number strips out the phantom accrual and shows you the actual liquidity being generated to support the dividend.
Okay, so let's transition to the other side of that paradox. We know the gap loss was a mirage created by soaring portfolio values. We need to dissect that surge in value.
We do.
Because moving the NAV from $13.53 to $14.95 is not a subtle shift. That is a violent repricing of the asset base. What specifically drove that $1.42 jump?
Well, CFO Taylor Ritchie isolated the primary driver. The increase was overwhelmingly the result of $1.77 per share of net unrealized capital gains.
$1.76.
Yeah. And during the Q&A segment of the call, Christopher Nolan from Leadenberg Thalmann probed this specific point, and Ritchie confirmed that these massive unrealized gains were isolated entirely within their equity portfolio, completely distinct from their debt holdings.
Which completely validates the entire dual mandate premise of the company. The debt provides the floor, the equity provides the ceiling.
Right. The debt is the defense, the equity is the offense.
But the composition of that equity surge is where the macroeconomic narrative gets completely inverted. Mickey Schlein, an analyst from Clear Street, pointed out that a massive chunk of this appreciation was concentrated in just 3 specific portfolio companies, Schilling, Old World, and SFA.
Yeah, let's focus intensely on Schilling and Old World because their success directly challenges the dominant economic consensus we are seeing at the end of 2025.
How so?
Right now, every major financial publication, every macro strategist is obsessing over the K-shaped economy.
Right, the K-shaped recovery model. For anyone who hasn't been buried in macro research, the K-shape illustrates a severe divergence in economic fortunes. Exactly.
The upper arm of the K represents the sectors and demographics that are thriving. Technology, automation, high-income earners insulated from inflation.
And the downward arm.
The downward arm represents everything getting crushed by structural headwinds. Lower-income consumers, heavy manufacturing, and particularly consumer discretionary goods facing supply chain friction.
Right. So the consensus macro playbook dictates that you want to be as far away from consumer discretionary companies as possible right now.
Right, because the consumer is supposedly tapped out, credit card balances are stretched, and on top of that, you have a brutal regime of international tariffs specifically targeting manufactured goods coming out of the Far East.
So the operating margins for a company selling non-essential consumer goods should, in theory, be collapsing under the weight of higher import costs and lower end market demand.
But then you look at Gain's portfolio, and their biggest valuation drivers are Schilling and Old World. What do these companies actually produce? Well, Schilling is a toy manufacturer, but their flagship product right now is a highly specific viral item called Nido.
Oh, the Nido toys. Anyone with a kid, or honestly anyone who spends more than 5 minutes on TikTok, knows exactly what these are.
Yeah, they're everywhere.
They're those squishy, highly tactile, shape-shifting stress toys. They are visually satisfying, sensory-driven products.
And David Dullum was very direct about their performance. He noted that despite the fact that a massive portion of Schilling's manufacturing base is located in the Far East, which exposes them directly to the brunt of the recent tariff hikes, they have experienced explosive, sustained demand.
Wow.
The consumer appetite for this specific product has completely overridden the friction of increased supply chain costs.
It is a modern manifestation of the lipstick effect, really.
Oh, absolutely.
That economic theory that even during periods of intense inflation or recessionary pressure, consumers will still allocate capital towards small, affordable luxuries.
Right.
You might delay buying a new car, you might cancel a vacation, but you will still spend $15 or $20 on a tactile sensory toy that provides immediate psychological gratification.
Because the demand is highly inelastic at that specific price point.
Right. And then you evaluate Old World. They manufacture Old World Christmas ornaments, hand-blown glass, incredibly detailed, highly collectible ornaments.
Yeah.
By any strict economic definition, this is the epitome of a discretionary purchase. There is absolutely zero utilitarian need for a glass ornament.
Sure.
Now, I will push back slightly on that purely out of respect for holiday traditions. Some families view that annual ornament purchase as a non-negotiable household expense.
Fair enough, yeah.
But From a strict macro perspective, yes, it is entirely discretionary. If the K-shaped economy is crushing the middle class, they shouldn't be buying premium glass ornaments.
Yeah, Dallin points out that both Schilling and Old World are operating at exceptional levels. Their management teams have not just survived the tariff environment, they have actively grown through it.
That's impressive.
They have figured out how to optimize their logistics, manage their inventory turnover, and, most importantly, maintain their pricing power in the face of rising input costs.
And this brings us to what I consider the absolute most critical sentence in the entire earnings transcript.
Okay, let's hear it.
Mickey Schlein asked a very pointed question about how these valuation increases were calculated. He wanted to know if the broader market just suddenly decided toy companies were worth more. Dallin responded, and I want to quote this directly, "Fundamentally, no multiple change, but pretty much all because of EBITDA increase."
Yeah, that single sentence fundamentally validates the entire underwriting philosophy of Gladstone Investment.
I really want to spend real time on this distinction because the difference between multiple expansion and EBITDA growth is the difference between durable wealth creation and just a speculative bubble.
Exactly.
During the call, there was a discussion about valuation methodologies. The CFO clarified that they don't rely heavily on discounted cash flow models. They value these private companies based on TEV multiples.
Right. Total enterprise value multiples. It is the bedrock valuation metric in private equity.
How does that work for someone who isn't familiar?
You take a company's EBITDA earnings before interest, taxes, depreciation, and amortization, which basically serves as a proxy for their core operating cash flow.
Okay.
You then apply a multiple to that number based on prevailing market rates for that specific industry. If a niche consumer goods company generates $15 million in EBITDA, and the market currently values that sector at an 8x multiple, the enterprise value is $120 million.
But there are two ways that $120 million valuation can increase, right? Let's say a year later, the company is valued at $150 million. The lazy assumption is just that the portfolio is doing great, but how did it get to $150 million?
Exactly. Scenario A is multiple expansion. The company is still only generating $15 million in EBITDA. They haven't improved their margins. They haven't sold more products. They haven't cut costs. But the broader financial markets have become euphoric. Interest rates drop, money is cheap, and suddenly investors are willing to pay a 10x multiple for the exact same cash flow. 10 times 15 million equals 150 million.
And that is wealth created entirely by market sentiment. It is paper wealth driven by the macro environment. And honestly, it is incredibly dangerous because the moment market sentiment shifts, the moment fear enters the system or liquidity dries up, that multiple can instantly contract back to 8x or even 6x. The valuation collapses and the gains evaporate, all without the underlying company actually changing its operational performance.
Right. But scenario B is EBITDA growth.
Okay, tell me about scenario B.
The market sentiment remains completely flat. The multiple stays firmly at 8x, but the company's management team gets to work. They negotiate better shipping rates. They implement a highly efficient digital marketing campaign for the Nideo toys.
Right.
They raise the price of the Christmas ornaments by 4% without losing any sales volume. Through sheer operational execution, they increase their actual hard cash flow from $15 million to $18.75 million.
And 8 times $18.75 million gives you that exact same $150 million valuation.
But the quality of that valuation is vastly superior. It is durable. It is built on fundamental operational improvement, not the whims of the broader market.
Right.
When Dallin states that there was fundamentally no multiple change, he is telling the market that gain is not riding a speculative wave. They are driving fundamental structural improvements at the asset level.
That is the ultimate validation of their control-oriented strategy. If they were just a passive mezzanine lender, they couldn't influence that EBITDA growth.
No, they'd just be sitting there.
But because they hold the majority equity, they can implement the operational changes necessary to drive that cash flow expansion, even when the macro environment is throwing K-shaped curveballs and tariff hikes at them.
Yes, exactly. However, while the equity side of the portfolio is clearly operating at peak efficiency and driving massive NAV growth, the debt side of the portfolio is facing a totally different, highly structural headwind.
Ah, right.
And this brings us to the primary friction point for any credit-focused investor right now.
We have to talk about gravity. We have to talk about the interest rate cycle. For the past several years, as the Federal Reserve aggressively hiked rates to combat inflation, floating rate lenders were the beneficiaries of an unprecedented windfall.
It was a great time to be a lender.
The structural mechanics of a BDC loan practically guarantee increasing revenues. When Gain underwrites a loan, the interest rate is usually pegged to a base rate, historically LIBOR, now SOFR, the secured overnight financing rate.
Right.
As the Fed pushed rates up, SOFR went up, and the interest payments collected by Gain mechanically increased without them having to lift a finger.
It was a mathematically perfect environment for a floating rate lender. But the macroeconomic tide has turned. The inflation data has cooled. The labor market is showing specific fractures, and the central banks have pivoted. Rates are coming down.
Now, gravity is returning to the credit markets.
Yes, and we saw the immediate mechanical impact of that gravity in this quarter's results. Taylor Ritchie detailed the numbers. The weighted average yield on their interest-bearing portfolio decreased from 13.2% in the prior quarter down to 12.9%.
So a compression of 30 basis points.
And Ritchie provided the direct causal link. That compression perfectly mirrored a 32 basis point decrease in SOFR over that exact same reporting period. The floating rate mechanism is functioning exactly as designed, but now it is functioning in reverse.
Right. And if I am an investor heavily weighted in Gain for that reliable monthly distribution, I am looking at that SOFR trajectory and projecting it forward. If the Fed cuts another 50 basis points and then another 75 basis points next year, my portfolio yield is going to keep dropping. 12.9% becomes 12.4%, then 11.8%. At what point does the yield drop so low that the $8.2 million of adjusted NII can no longer cover the dividend payouts? I mean, this is the core fear driving the market's current skepticism of BDCs.
And the fear of uncontrolled spread compression is valid, if you assume this decline is linear and infinite. But that assumption completely ignores the primary structural defense mechanism embedded in these credit agreements. We need to examine the architecture of the interest rate floors.
Okay, I look at interest rate floors as a contractual parachute.
Oh, that's a good way to put it.
If you jump out of a plane, gravity in this case, the dropping SOFR rate is pulling you toward the ground. For the first few thousand feet, you are in free fall. Your yield is dropping point for point with the broader market.
Right.
But at a predetermined altitude, you deploy the parachute. You don't start moving completely, but your rate of descent hits terminal velocity. You glide. The interest rate floor dictates exactly when that parachute deploys.
Exactly. When Gain structures a credit facility for a portfolio company, they do not offer an uncapped, limitless floating rate. The contract explicitly states that the borrower will pay a specific spread over SOFR, say 6%. But it also contains a hard legal provision stating that for the purpose of calculating the interest payment, the base SOFR can never fall below a certain threshold.
Let's run a hypothetical scenario to make this concrete. Say the contractual floor is set at 3%. If actual market SOFR drops to 1%, the borrower does not get the benefit of that 1% rate.
Nope.
They are legally obligated to calculate their interest payment using the 3% floor. The borrower absorbs the friction, and the lender's yield is protected.
And Taylor Ritchie provided the exact altitude of Gain's parachute during the call. Excluding non-accruals and revolving credit facilities, the weighted average interest rate floor across their entire debt portfolio right now is 12.1%.
I want to pause on that number because it is staggering. The current weighted average yield is 12.9%. The absolute rock bottom weighted average floor is 12.1%. That is not a parachute that deploys thousands of feet down. That is a parachute that deploys almost immediately.
It really is. The downside exposure is incredibly tight. It is a profoundly defensive posture.
Yeah.
Ritchie further clarified that over half of their entire debt portfolio is already operating at the interest rate floor.
Wait, half?
Over half. For more than 50% of the loans on their books, the SOFR freefall has already been arrested. If the Federal Reserve announces an emergency 200 basis point rate cut tomorrow, the interest income generated by that half of the portfolio will not decline by a single fraction of a penny.
That fundamentally changes the risk profile. But Mickey Schlein pushed for even more granularity on this, didn't he?
He did. He looked at the sensitivity tables provided in the release and asked a clarifying question to ensure the math tracked. He wanted to confirm that the remaining half of the portfolio, the loans not yet at the floor, only had roughly 80 basis points of downward exposure before they, too, hit the concrete.
And what did Ritchie say?
Ritchie confirmed the math, but he added a vital layer of context regarding how SOFR actually moves against those floors. He noted that to drive the entire portfolio down to that 12.1% blended floor, you would need to see a massive 210 basis point drop in SOFR from current levels.
Meaning the broader economy would have to experience a severe recessionary level slashing of interest rates before Gain's portfolio yield fully bottomed out at 12.1%.
Exactly.
But here is the friction point I want to explore. If market rates drop by 210 basis points and a portfolio company is forced to keep paying Gain 12.1% because of a floor, isn't that company just going to refinance the debt?
That's the logical question.
Right. If the market rate is 8% and Gain is forcing them to pay 12%, a rational CEO is going to go to a different bank, borrow at 8%, and pay Gain off. That prepay risk destroys the yield anyway.
In a highly liquid investment-grade corporate bond market, yes, prepay risk is massive.
Yeah.
But you have to remember the ecosystem Gain operates in. This is the lower middle market.
Right.
These are highly structured unitranche facilities. You cannot just seamlessly refinance a $40 million specialized debt facility on a Tuesday.
It's not like refinancing a house.
No, it takes months. Furthermore, Gain owns the majority equity in these companies. They control the board. The portfolio company cannot simply initiate a hostile refinancing of the parent company's debt facility without board approval. The structural integration of the debt and equity completely neutralizes traditional prepay risk.
That is the hidden genius of the unitranche sponsor-controlled model. They dictate the terms of the capital structure from both sides of the table. And to further fortify this position, Ritchie noted that the new deals they are underwriting right now in this exact rate-cutting environment are being structured with elevated floors in the 13% to 13.5% range. They are actively pushing the altitude of the parachute higher.
They're logging in historically high absolute yields while simultaneously capping the downside. The empirical data strongly refutes the narrative that Gain's dividend is in imminent danger from spread compression. The fortress they have built around their yield is exceptionally robust.
So we have dissected the past quarter. We understand the gap illusion. We understand the incredible EBITDA execution driving the NAV, and we have stress tested their defenses against falling interest rates.
Right.
But a BDC cannot survive in stasis. The engine must constantly be fed new capital. Let's pivot to the forward-looking trajectory. Let's examine management's guidance on the M&A landscape.
Capital deployment is the lifeblood of this model. If a BDC is not actively originating new loans and acquiring new equity stakes, their portfolio will naturally amortize and shrink as old loans are paid off. David Dullum addressed the origination pipeline directly, describing it as very healthy.
And the deployment numbers back up that assertion. For the first 9 months of fiscal 2026, Gain has successfully invested approximately $163 million across 4 new portfolio companies, including 1 brand new buyout executed in this specific quarter.
And to contextualize that velocity, you have to look at the prior year. In all of fiscal 2025, which covers a full 12 months, they deployed $221 million. So at $163 million through 3 quarters, they are tracking almost perfectly with their historical deployment cadence. The machine is functioning smoothly.
But Dullum was also remarkably candid about the friction in the current market, wasn't he?
Yeah, he didn't sugarcoat it.
He didn't paint a utopian picture. He explicitly warned that the broader M&A market is awash in liquidity. There is an enormous amount of dry powder sitting in private equity funds, and standard credit is widely available.
And that creates a highly competitive, aggressive bidding environment for quality middle market assets. When liquidity is high, valuations get stretched. Too much money chases too few quality deals.
Right.
Christopher Nolan, an analyst on the call, homed in on this exact dynamic. He brought up a fascinating structural nuance. He noted that while debt is easily accessible for these target companies, the availability of actual equity capital from standard sponsors seems to be tightening. He asked Dullum if this specific imbalance provided Gain with a competitive wedge.
This leads to a masterclass in capital structure strategy. We need to compare how a massive traditional private equity firm operates versus how Gain operates in a competitive bidding scenario.
Okay.
If a traditional PE sponsor wants to buy a manufacturing company for $100 million, they do not write a $100 million check from their fund.
No, that would completely ruin their internal rate of return. Traditional private equity relies entirely on the mechanics of the leverage buyout.
Right.
They will commit perhaps $25 million of your own equity, and then they will frantically go to the credit markets, to a syndicate of banks or a massive direct lender to borrow the remaining $75 million. The entire viability of their bid is contingent on a third party agreeing to fund that leverage at a specific interest rate.
And Dulum acknowledged that right now, those traditional sponsors can access that leverage relatively easily, which allows them to bid aggressively. But Gain counters that aggressive bidding with a completely different weapon: certainty.
Exactly. Certainty is huge.
When Gain submits a term sheet to buy a business, they are employing their standard formula, which Dulum outlined as roughly 70% debt and 30% equity. But the crucial distinction is that Gain is providing both.
Both parts of the stack.
Yes. When they shake hands with the seller, there is no financing contingency. They do not have to spend the next 45 days begging a bank committee to approve the debt tranche. They speak for the entire capital stack.
Put yourself in the shoes of a 60-year-old founder selling a family business. You have two identical $100 million offers on the table.
Okay.
One is from a Wall Street PE firm that says, well, we will buy your company, assuming the credit markets don't freeze up next month and our lenders don't get spooked.
Sounds stressful.
Very. The other is from Gain, who says, the money is already in our account, we can close the deal tomorrow. That certainty of execution is an incredibly powerful psychological and financial advantage. It allows Gain to win competitive deals without having to inherently overpay on the TV multiple.
And they were refusing to overpay. Justin, an analyst sitting in for Eric Zwick at Lucid Capital, pushed Dulum on this exact point. He asked if the intense competition was forcing Gain to compromise on their underwriting standards or accept thinner yields just to get money out the door.
And what was his response?
I loved Dulum's response to this because it was entirely devoid of executive spin. He flatly said no.
Just no.
Just no. He stated they maintain strict discipline, targeting an effective yield on the debt that cleanly clears their own cost of capital, while simultaneously demanding a path to a 2x cash-on-cash return on the equity portion. He freely admitted that they have recently walked away from multiple deals because they were a couple of turns off on the multiple.
A couple of turns, meaning the seller wanted a valuation that was 2 or 3 times higher on an EBITDA basis than Gain was willing to underwrite. Walking away from those deals is the hallmark of a mature, disciplined capital allocator. It prevents the exact kind of multiple contraction disasters we discussed earlier.
But to maintain that discipline and still generate a massive yield, Gain has to relentlessly optimize the liability side of their own balance sheet. They have to manage their own cost of capital. You cannot lend money at 13% effectively if it costs you 10% to borrow it in the first place.
Right. And Taylor Ritchie detailed a phenomenal piece of financial engineering executed this quarter to address exactly that.
Yeah, tell us about that.
This was a brilliant, almost stealthy move that fundamentally improves their operating leverage. Gain had $74.8 million in outstanding notes that carried a brutal 8% interest rate.
Ouch.
Yeah, in a falling rate environment, carrying a fixed 8% liability is a massive drag on your net interest margin.
So they executed a classic corporate refinance. They called the full $74.8 million balance, completely redeeming those expensive 8% notes. To fund the redemption, they issued $60 million in brand new notes at a significantly lower rate of 6.875%. And they utilized their existing credit facility to cover the remaining balance.
The math on that maneuver is incredibly accretive. Ritchie pointed out that this refinance permanently reduced the interest burden on that specific block of capital by approximately 110 basis points. That is not a one-time gain. That is a permanent structural reduction in their quarterly operating expenses. Every dollar saved on that interest expense flows directly down the income statement to support the adjusted NII and the dividend.
It is identical to refinancing your primary mortgage from 8% down to under 7%. Your underlying asset hasn't changed, but your monthly cash flow instantly and permanently improves. Furthermore, Ritchie noted that they expanded their core credit facility. They brought City National Bank into the syndicate, increasing the total commitment level of the facility to $300 million.
With $171 million of that facility still completely undrawn and available, they have constructed a massive reservoir of dry powder. They have lowered their cost of capital, expanded their borrowing capacity, and positioned themselves to strike immediately when their strict underwriting criteria are finally met by a willing seller.
So the structure is optimized, the funding is secured, but no credit portfolio is immune to friction. No matter how rigorous the underwriting, when you lend billions of dollars to middle market companies, some of them are going to stumble, which requires us to look at the ugliest metric on a BDC balance sheet, the non-accruals.
Non-accruals are the ultimate red flag for asset quality. When a portfolio company breaches covenants, stops paying interest, or shows signs of severe distress, the BDC is forced to place the loan on non-accrual status. The moment that happens, the BDC can no longer recognize the anticipated interest from that loan as revenue on the income statement. It is a direct hit to current cash flow and an ominous signal about potential principal loss.
Justin from Lucid Capital probed the non-accrual list, looking for signs of contagion in the portfolio.
The data, however, showed stability. Gain currently has exactly 3 portfolio companies on non-accrual status. When you look at the entire portfolio, those 3 companies represent 3.8% of the total assets based on their original cost, but they only represent 1.5% of the portfolio at current fair value.
1.5% at fair value is a remarkably contained exposure level. In a high-yield credit environment, maintaining a non-accrual rate under 2% is a testament to incredibly aggressive risk management. But what I found fascinating wasn't the percentage. It was David Dullum's rhetoric when discussing these 3 troubled assets.
Yeah, that was surprising.
Historically, when a CEO discusses a non-accrual on an earnings call, the tone is somber. They use phrases like maximizing recovery or exploring restructuring options. They sound like they are preparing the market for a write-off.
Dullum's tone was entirely different. He was demonstrably optimistic. He stated that he felt significantly better about the trajectory of those specific companies today than he did just 3 months prior. He even used the phrase game changer regarding potential upcoming catalysts.
And he revealed the core reason for that optimism. All 3 of these companies currently on non-accrual are actually generating positive EBITDA.
This is where we need to dig into the mechanics of distressed private equity. If a company is generating positive operating cash flow, the logical question is, why aren't they paying their interest bill? Why are they designated as distressed?
That was my exact reaction. Are they hiding the cash? Are they in some massive covenant breach that forces gain to trap the capital?
Dullum vaguely referred to structural reasons keeping them on non-accrual, but the reality of middle market restructuring provides the blueprint. When a company faces a liquidity crunch or needs to fund a massive operational turnaround, perhaps installing a new ERP system or integrating an acquisition, the equity sponsor, which in this case is also Gain, will often execute a forbearance agreement. They will tell the company, stop paying the cash interest to the debt side of our house. Trap that cash on your balance sheet, use it to fix the operational issues, and we will accrue the interest in the background.
It is a deliberate strategic starving of the debt yield to protect the long-term viability of the equity asset. Because Gain owns both, they aren't fighting with an outside lender who is threatening to force the company into bankruptcy to recover their principal. They can patiently orchestrate the turnaround.
Exactly. And Dullum hinted that these turnarounds are reaching an inflection point. He suggested that one of these companies might be nearing a complete exit, and another might see sufficient operational improvement to be restored to full accrual status in the coming quarters.
If they resolve those structural issues, if they turn the interest hose back on, or if they successfully exit the asset, that 1.5% of the portfolio suddenly transforms from a drag on earnings into an immediate catalyst for NAV recovery and income growth. It is a hidden pocket of upside buried inside the ugliest metric on the balance sheet.
It's the ultimate validation of their hands-on, control-oriented strategy. They do not passively accept losses. They leverage their equity position to restructure, rebuild, and ultimately recover the value.
All right, we have covered an immense amount of ground. We have deconstructed the Jap accounting paradox, analyzed the K-shaped economic divergence through the lens of tactile toys and glass ornaments, mapped the mathematical limits of the SOFR freefall against their interest rate floors, compared their M and A strategy to traditional LBO mechanics, and explored the hidden optionality within their distressed assets.
It really unpacked a lot.
We did. We need to synthesize this. Let's get to the bottom line. Based on the totality of this data, what is the fundamental verdict for the retail investor?
If you strip away the noise of the mark-to-market accounting and evaluate the core engine of Gladstone Investment, the verdict is unequivocally bullish. You were looking at a management team that is navigating a highly complex macroeconomic transition with exceptional precision.
I agree entirely. Let's build a summary case. First, the optical illusion of the $6.5 million GAAP net investment loss is entirely a byproduct of massive operational success. They are being penalized on paper because their portfolio companies are generating so much raw fundamental value that the theoretical incentive fees spiked. That is the definition of a luxury problem.
Second, that value creation is not speculative. A $1.42 per share jump in net asset value driven by companies like Schilling and Old World increasing their actual EBITDA in the face of supply chain friction and tariff regimes proves that Gain's underwriting and operational oversight is highly effective. They are not reliant on multiple expansion.
Third, the primary existential threat to a BDC right now, the collapse of SOFR, has been structurally neutralized. With a weighted average portfolio yield of 12.9% resting on a weighted average interest rate floor of 12.1%, the downside risk to their primary income stream is strictly limited even if the Fed continues an aggressive rate-cutting cycle.
And finally, they are actively optimizing their own capital structure. Redeeming 8% debt and replacing it with 6.875% debt permanently expands their net interest margin, providing further foundational support for the operations. They're operating from a position of profound strength.
So what does this actually mean for your portfolio? If you hold Gain, or if you are modeling an entry point, what is the actionable takeaway regarding the capital return strategy? It all anchors back to the distribution.
Gain currently distributes a regular monthly dividend of 8 cents per share, which equates to 96 cents on an annualized basis.
Yeah.
Based on the $8.2 million in adjusted net investment income generated this quarter and the defensive posture of those interest rate floors, that baseline monthly distribution appears completely secure. It's fundamentally supported by recurring cash flow.
But evaluating Gain purely on the baseline dividend is a fundamental miscalculation of the asset's potential. The true alpha generated by this specific ticker comes from the supplemental distributions. Because Gain takes massive equity stakes in these buyouts, they periodically realize enormous capital gains when they exit a position. And to maintain their specialized tax status as a regulated investment company, they are legally required to distribute the vast majority of those realized gains back to the shareholders.
Taylor Ritchie provided historical context for this that is absolutely staggering. He noted that over the last 5 fiscal years, Gain has authorized and paid 13 separate supplemental distributions. During that 5-year window, an investor received $4.68 per share in standard monthly dividends. But on top of that, they received an aggregate of $3.26 per share in supplemental bonus payouts.
The equity engine essentially doubled the yield over a 5-year period. And the critical data point for the forward-looking investor is that this engine is fully primed right now. Ritchie disclosed that as of December 31st, Gain is sitting on an estimated spillover income of approximately $22.9 million.
Spillover income is realized, taxable profit that the company has successfully generated but has not yet distributed to the shareholders. It is a massive $22.9 million reservoir of cash. That translates to roughly 58 cents per share just waiting to be deployed. Ritchie was explicit in stating that supplemental distributions will continue to be a primary mechanism for shareholder returns going forward.
They have the spillover cash ready to deploy, and they have an equity portfolio that just generated a massive wave of unrealized gains that are waiting for an eventual exit event to be monetized. Even with the NAV surging to $14.95, the combination of a protected high-yield debt floor and a proven highly lucrative equity upside creates a risk-reward profile that is incredibly compelling.
It is a fortress balance sheet funding a high-growth equity strategy.
We are going to wrap up this analysis, but before we conclude the deep dive, I want to leave you with a broader, potentially provocative thought, a thesis to ponder that extends far beyond the specific mechanics of Gladstone investment.
Yeah, this is a really interesting point.
We spent significant time analyzing the explosive growth of Schilling and Old World. We discussed tactile toys and glass Christmas ornaments. These are the purest definition of consumer discretionary goods. And yet, they are driving massive EBITDA growth in a macroeconomic environment that is supposedly defined by a crushed K-shaped consumer. Mickey Schlein's question about how this is possible amidst rising international tariffs is the central paradox of the current market.
David Dullum's explanation essentially boiled down to undeniable consumer demand overriding inflationary friction. If you have a good product, the consumer will absorb the price increase.
This dynamic forces us to ask a massive systemic question about the broader economy. If the middle market companies producing non-essential stress relief toys and premium holiday decorations are generating record cash flows and effortlessly absorbing higher supply chain costs, is the American consumer fundamentally vastly more resilient than the macroeconomic headlines are reporting?
Are we collectively misreading the diagnostic codes of the entire economy? Every macro strategist is bracing for a consumer recession, demanding that you rotate into defensive sectors. But the actual granular on-the-ground data from the middle market, which is the true beating heart of the American economy, suggests that consumers are still aggressively deploying capital toward the things that bring them immediate psychological joy.
If the consumer is truly this robust, despite the constant narrative of the K-shaped collapse, how many other consumer-oriented equities in your portfolio or in the broader market are currently mispriced because they are being weighed down by phantom macro fears?
It's a great question to ask yourself.
It brings us perfectly back to the flashing red light on the dashboard. The macro headlines are flashing red. The gap accounting is flashing red. But when you plug in the scanner, when you look at the raw EBITDA, the interest rate floors, and the spillover income, the engine is generating more horsepower than ever. You just have to be willing to look past the warning light and read the actual code.
And the code today tells a story of exceptional operational strength.
Thank you for joining us on this edition of The Deep Dive. Keep questioning the consensus, keep digging past the headline numbers, and we will see you next time as we continue to unpack the real mechanics driving the markets. Have a great day.